So you want to become an income investor. I built a 6 ETF portfolio. Let's break down exactly what it pays at different investment levels. Welcome back everyone, I'm the Swedish dividend investor. So today we are going to take a look at an example portfolio and how to build a passive income stream using ETFs. I made a spreadsheet and we will go through the following. A brief overview of the 6 holdings and what they are. We are going to use 2 inputs, tax rate and invested capital. We will use an equal weight approach. And we will take a look at the income produced by capital invested. As always, this is not financial advice. I'm just sharing my own investing journey, my experiences and my analysis. Read the full disclaimer in the description. So, before diving in, I want to quickly explain income investing. Income investing makes it possible to boost your current income, often at the expense of long-term growth, such if you were to invest in growth or dividend growth ETFs. The future is uncertain, but the present isn't. I see it as a classic Swedish proverb. Hellre en fågel i handen än 10 i skogen. Or, as you say in English, a bird in the hand is worth 2 in the bush. I know what income I get now, but I don't know the growth in the future. Alright, so here is the spreadsheet. This is pre-recorded, so prices might have changed, but I just want to give you guys some inspiration. The example today is a conservative equal weight portfolio with 6 holdings. We are not maximizing the yield, but we are aiming for a pretty decent after-tax yield. All the ETFs are domiciled in Ireland. As you can see on the bottom, I do have a lot of different portfolio ideas, so let me know if you want to see that in a future video. We have the 2 inputs, tax rate and capital invested. Ignore the holdings tabs. This is preset to 6 holdings to divide the capital equally, 16.67% to each holding. Let's take a look at the holdings. First off we got ASWN or PFFI, Han ETF Infrastructure Capital Preferred Income ETF. It's an ETF holding preferred shares. It is actively managed and they use a slight leverage, no more than 25%, to both increase the value of the ETF and to boost the income. Preferred shares usually have a fixed call price and a fixed dividend. They pay monthly and the distribution since launch has been the same every month. So it's a very stable payer, but nothing exciting when it comes to its share price, since that's the whole point of preferred shares. Their current yield is around 8.3%, and since they don't do covered calls, they don't have any moneyness. We also have KNG, First Trust Vest S&P 500 Dividend Aristocrats Target Income ETF. This ETF holds Dividend Aristocrats, companies that have raised their dividend for over 25 years, so very defensive companies. They sell call options to generate extra income. Now, this is a small but growing ETF and it is one of my favorites. They pay distributions monthly and their current yield is around 8.3%. I know I jap about these holdings all the time. That's because I like them. Their moneyness is at the money, meaning they write options close to the trading price 30 days out, risking to sell away all the upside. However, they are usually pretty conservative. As a reference, their end of March option overlay was under 17%, having 83% upside participation. If you want to know more about covered calls, I have linked a video in the description. Next up is JEIP, JPMorgan Europe Equity Premium Income ETF. A fairly new one, but I would say a must-have ETF for European high-yield investors. They trade in euros and they distribute in euros, so we don't really have the currency risk. Well, we do have some, but it's not tied to the US dollar. It's decently diversified between the European countries, like Germany, Switzerland, Sweden and whatnot. They pay monthly, but we don't know their yield yet. The first distribution was very high, but I've gone for an annualized yield of 8.7%. Their target is between 8 and 10%. Their moneyness is out of the money. Setting a higher call price means less risk of upside loss. JPMorgan usually only sells calls on a maximum of 80% of their portfolios. Sadly, they don't disclose how much they use each month. We also have JEIP, JPMorgan US Equity Premium Income ETF. I know, I sold this one, but it could be a great play in a conservative portfolio. I traded my position for a more aggressive yield. They hold about 230 companies, so it's not like the S&P 500, but they do got some heavy tech exposure, and this ETF is US focused. They pay monthly, and their current yield is around 7.6%. Their moneyness is also out of the money. Next one is JGPI, JPMorgan Global Equity Premium Income ETF. This is the first JPMorgan covered call ETF we Europeans had access to. It has been lagging as of lately, but as one of my biggest positions, I do think they will make a comeback. If we look at their returns in US dollar, it's not really that bad. They have a great deal of US focus and hold around 240 companies, but also a lot in international stocks. They also pay monthly, and their current yield is just above 8%. Their moneyness, like all the JPMorgan ETFs, is out of the money. Final one, WINC, iShares World Equity High Income ETF. Ah yes, the best performing options, futures and derivative income ETF in Europe. It has performed excellent since launch, with its high yield and its price games. WINC, as the name suggests, focus on global equity, but just as JGPI, this means heavily in the US. Comparing it to JGPI, we can see it does hold more companies, almost 160 more than JGPI. We also see much higher concentration into tech and heavier allocation into its top 10 holdings. We have Nvidia, Apple, Microsoft, Alphabet and Amazon in the top, compared to JGPI's Johnson & Johnson, Southern Corp, AT&T, Microsoft and McDonald's. So I would say JGPI is a bit more conservative. This also shows in the volatility, lower for JGPI, and maximum drawdown since inception is 11.31% for JGPI and negative 18.47% for WINC. So yes, it will be a bumpier ride, but you also get rewarded when the top holdings go on a run. The one and only reason I don't invest in WINC is pretty stupid. I wish they paid monthly. I do consider investing into it if I, for example, sell my tobacco or oil stocks, since they also pay quarterly. Enough japping. Like I said, they pay quarterly and their current yield is about 9.25%. Pretty awesome, since their strategy involves more than just options. It's hard to exactly pinpoint what their moneyness is, but it seems to be out of the money. I do have some charts as well, but I will show them once we have started with the examples. I'm a small creator on YouTube. Hitting the like button, commenting and subscribing helps the channel massively. Thanks! Nice, now we know what's inside the portfolio. Let's run some examples. We will do a few examples where we change the invested capital and the tax rate. For the first example, I will use the tax laws of Sweden. If you only held these ETFs, since they are all domiciled in Ireland, you don't pay any tax on the distributions. So let's roll with the first example. Let's assume it's your first year of investing and you can save 1,000 euros per month. Your first year, you would have invested 12,000 euros. We can see the yield on cost of the portfolio is 8.41%. And since there is zero tax, we get to keep all the income. The income is 1,009 euros per year, so a free month of savings per year. We don't have a true monthly income since we hold WINC, but on average we're looking at 84 euros per month. Checking the charts, this is the same for every example by the way. We can see geography, moneyness and defensive/risky. I put JEIP and WINC under risky, since they hold a lot high flying tech as their top holdings. That's my opinion, yours might differ. I would say it's a pretty balanced portfolio. Decent diversification, good yield and pretty defensive. Alright, let's bump up the numbers a bit. Now you might have some years of investing behind you. Let's say you invested 50,000 euros into this. Now we're looking at an annual income of 4,205 euros or 350 euros per month. That's pretty sweet. Let's do my portfolio value next. If I were to sell it all and buy this, it's currently about 135,000 euros. Now we're at an annual income of 11,354 euros or 946 euros per month on average. Let's do one last example. A pretty wealthy investor. I would say this isn't too far out there. Let's go with 400,000 euros. Annual income of 33,641 euros or 2,803 euros per month. Wow, imagine getting that income. Moving on with the tax example. This was a pretty hard nut to crack, since Europe has a lot of different tax rates. But I looked up the average dividend tax across Europe, and it is about 24%. I can't sit here and punch in every tax rate imaginable, so we're going to roll with that. Same examples as before. The beginner investor with 12,000 euros in capital. Now, the top line is the same, but after tax, we can see the annual income is now 767 euros or 64 euros per month on average. The yield on cost has also changed to 6.39%. Now, we can't get away from paying the taxman. I know it sucks. If you think this is a bit underwhelming, keep in mind the tax also applies to lower yielding investments. A quick example, a yield of 2.5% becomes a yield of 1.9% with a 24% tax rate. Let's continue with the examples. Let's do the investor with some experience. 50,000 euros invested. Now we're looking at an annual after-tax income of 3,196 euros or 266 euros per month on average. Still nice money coming in. And for the larger portfolio, 135,000 euros, annual income of 8,628 euros or 719 euros per month on average. For the final example, 400,000 euros, annual income of 25,566 euros or 2,130 euros per month. That would be enough for me to cover all my expenses and then some. So, what's the strength of this portfolio? I would say it is pretty conservative as far as high yield investing goes. I think the biggest pro you have as an income investor is the freedom factor. Sure, your first year you can maybe just cover 1 or 2 bills or dine out once a month using the distributions if you would want that. But in the later years you could do whatever you want with the distributions. Save them as a cash buffer, pay a vacation, cover your bills or reinvest. It's easier to stay on the course and keep investing, especially in bad times when your income keeps hitting your account. Yes, we might sacrifice some long-term capital gains, but honestly, the sleep well at night factor and the freedom current income provides is enough for me. Who cares if you don't beat the market? Invest in what makes sense for you. If I make 7 or 12% per year, it doesn't matter to me. I invest for freedom, and in my opinion, the best way to get there is through income investing. I want to know what you think about this portfolio or your opinions on income investing. We are all different and we use different styles. Let me know what you think. Thanks for watching. I will see you guys in the next one. Until then, stay smart, stay patient and keep stacking those dividends. Ha det gött!